Good morning. It's Friday, the 30th of August, and this is Govindraj Ethiraj, headquartered and broadcasting and streaming from Mumbai, India's financial capital. The take, the importance of friction in payments. For the last few years, the financial system in India, led by financial technology companies or Fintechs as they're called, have strived to reduce the friction in the system, which means combined with unified payment interfaces or UPIs and the like, payments whether peer-to-peer or with banks has speeded up to levels never seen before. Similarly, we are now mesmerized by the simplicity with which, thanks to a swipe on the smartphone, we can take instant loans, buy now, pay later, and invest in stocks and shares of all kinds. This is one reason why the financial system is today overheated, from personal loans to investments in stocks or worse, derivatives. The core report has argued in the past that we need to introduce more friction now, particularly in some segments of the financial system, to slow down transactions. Christopher J. Waller, a governor on the board of the Federal Reserve, America's equivalent of the Reserve Bank of India, has made a powerful case for reducing friction. I repeat, reducing friction. And he said this at the Global Fintech Festival this week in Mumbai, quite likely to the embarrassment of some present there. Not all frictions that slow payments down are bad. Certain frictions are purposely built into the global payment system for compliance and risk management reasons. Slowing down the speed at which payments are cleared and settled helps banks prevent money laundering and counter the financing of terrorism, detect fraud, and recover fraudulent or misdirected cross-border payments, he said. Now, he was speaking in the context of interlinking fast payment systems and responding essentially to the proposition that we should be able to make payments to a cousin in, let's say, the United States with the same speed and efficiency I can make a mobile phone linked payment on Google Pay or Bheem. So according to him, while the practice today of sending payments through an often complex chain of correspondent banks contributes to slower payments that could benefit from efficiency enhancements, there was no silver bullet that increases speed and efficiency without trade-offs. Unless new solutions are found, he said, interlinking fast payment systems might increase the risk management burden for banks that participate in them. He then asked if we can necessarily assume that all parties to a cross-border transaction want faster payments. The fundamental friction in any transaction is that the seller of an object, a can of soup, an hour of labor, or a good manufactured for export wants to receive their money as fast as possible. However, the buyer of the object or the buyer's intermediary typically has an incentive to wait as long as they can to pay for something that they have purchased. Under this logic, senders need to be properly incentivized to speed up cross-border payments. And remember, all this discussion is about cross-border. The one exception may be person-to-person remittances, where workers from other countries want to send money home and recipients want access as fast as possible. But remittances are apparently only a small percentage of the value of cross-border payments, so we need to weigh the benefits against the costs of a potential public sector intervention to shift incentives. So, Christopher Waller asks, I'm still left with the larger question of whether we should be incentivizing faster cross-border payments. And then he, of course, goes on to the costs of faster payments and who will eventually bear it. And all these apply in some ways to domestic intra-country transfers in India as well. He also provides the example of the low-cost international ACH payment network between the United States, Europe, and Canada, which he says has not worked. And here's a point that many forget. The infatuation of finding a technology solution cannot override the social, legal, and other constructs that drive financial systems and payments in a country. Because technology, as Mr. Waller points out, also is the easier part. The legal compliance, settlement, and governance challenges are more substantial, he says. So let's come back to India and look at another angle. Scores of people daily are now scammed by fraudsters who send SMSs, WhatsApp messages, and mails to you and me. Sometimes it's about us investing our money somewhere, sometimes extortion, and sometimes a simple con, like a message that sounds like it came from a colleague who desperately needs money. Between reported and unreported, it's safe to say that millions of dollars or crores of rupees of people's hard-earned money is being lost every month, and in many cases not recovered. Enabling all of this, among other means, is frictionless transfers via UPI to bank accounts, where it turns out that despite all the mind-numbing levels of bank KYC or Know Your Customer processes that normal people have to go through, there are evidently KYC-less mule accounts which are collecting the money and transferring them elsewhere. Of course, UPI is not the only device and there are many more, but nothing connects all of them so well as the basic proposition of speed, efficiency, and of course, anonymity. Which brings us to the compliance and legal part that Mr. Waller spoke about. We for sure need more frictionless transactions. For instance, can we bring it down by 20% in the case of buying homes or buying a car and then taking loans to do that? What we do not need is so much ease of transactions that a financial system could collapse on small savers and investors one day. And that brings me to the top stories and themes for the day. The markets are on the longest rising streak for 17 years now. Reliance says it will double earnings in retail and telecom in 3 years, considers a bonus issue. Defense stocks, once a darling, are now falling. Corporate growth is moderating, says Crisil rating, slowest in 15 quarters.
This is the Core Report with Govindraj Ethiraj.
The markets continue to rise. To use an old cliche, the markets seem to be on a slow and steady climb up the hill, except that we can't see the summit. The Nifty 50 has now risen for 11 consecutive sessions, adding about 4% to post its longest winning streak since October 2007, says Reuters, adding that Indian markets are now amongst the top performers globally this year, that's 2024, helped by strong domestic inflows and, of course, a strong economic and earnings outlook. And the BSE Sensex and Nifty 50 hit, of course, record highs on Thursday, thanks also to Reliance Industries, and more on that shortly. The Nifty 50 and Sensex also hit fresh all-time highs, the BSE Sensex hitting 82,285, closing up 82,134, up 349 points, while the Nifty 50, which touched a high of 25,192, closed about 100 points higher at 25,151. Defense stocks continue to lose. So while the markets are at a high, defense stocks have been on a downward journey ever since the presentation of the Union Budget for 24-25, according to the Business Standard. The reason I bring up these defense stocks, of course, is the fact that they are a good representation of the highly stressed valuations we're seeing in the market in general and in some sectors specifically. So the examples quoted are shares of Garden Reach Builders, which are down about 27%, Cochin Shipyard down about 21%, BEML 15%, Mishra Dhatu Nigam 13%, DCX Systems about 13%. Now, many other defense or linked stocks have also fallen, but maybe a little less. In this period, the Nifty 50 has gained 2.2%. So the reason attributed is that defense allocation at about 6.21 trillion rupees did not really increase from the previous year in the Union Budget, and that seems to have turned sentiment around. Now, most of these companies are in good shape in general, but to reiterate a point that we've made earlier, the valuations are just too stretched. Monsoons may prolong into late September. India's monsoons are likely to prolong into late September this year thanks to the development of a low-pressure system in the middle of the month, according to Reuters quoting two Weather Department officials. Above normal rainfall, thanks to a delayed withdrawal of the monsoon, could damage India's summer-sown crops like rice, cotton, soybean, corn and pulses, which are typically harvested from mid-September. Now, the crop damage could lead to food inflation, but the rains may also result in higher soil moisture, benefiting the planting of winter-sown crops such as wheat, rapeseed, and chickpea, said Reuters. A senior official of the Indian Meteorological Department also told Reuters that there is an increased probability of a low-pressure system developing in the third week of September, which could delay the withdrawal of the monsoon. Interestingly, a research report from HSBC's economists says that more than rains and reservoirs, temperatures matter when it comes to food output and inflation. HSBC says that the correlation between average temperatures and food inflation has risen sharply over the last decade. According to them, reservoir levels, which they used to track closely earlier, matter less now because impact of low rains can be better managed thanks to improving irrigation facilities. So with all of this, including the fact that the worst of high temperature periods are gone or behind us, HSBC predicts that food inflation could fall over the next few months by 2 percentage points, all of which could lead to, let's say, the chances of interest rates coming down faster. Reliance AGM and AI. It's interesting that while businesses world over are now moderating their stance somewhat on AI investments in keeping with business outcomes or objectives, Reliance Industries made it a center point in their interaction with shareholders yesterday at their 47th annual general meeting. Chairman Mukesh Ambani said Reliance would also double in size in 6 years and would double sales and operating profits in its telecom and retail businesses over the next 3 to 4 years, and more on that shortly. Reliance spoke of an all-encompassing AI strategy, which the oil to chemicals major proposed to inject into all its operations, both consumer-facing and otherwise. Reliance also said it was developing a suite of AI tools and platforms called GeoBrain and setting up data centers in Gujarat, which it plans to power with green energy. Our goal is to create the world's lowest AI inferencing cost right here in India, which will make AI applications in India more affordable than anywhere else, Mr. Ambani said, quoted by Reuters. So to now get a sense on how the markets and analysts were viewing Reliance's AGM, I reached out to Deven Choksey, veteran market and Reliance watcher and founder of DRChoksey Finserv, and I began by asking him what he took away from the AGM speech.
Well, I think at the outset, Govind, I find that so much of clarity has been provided by the chairman in the AGM. I think the cornerstone of this entire speech is that implementation of AI at every business level in the company. And so very beautifully, they have thought about the entire subject. They are talking about bringing up the efficiency. They are talking about bringing up the accuracy. They are talking about the bringing up of complete sustainability in the business. And at the same time, talking about increasing the profit margins in the commoditized businesses, where they are saying that I think with the use of AI, probably I think they are going to remain fully charged up with these particular businesses. They are talking about industry 4, even in the new segment of business, which is renewables. And I think that's where probably you get a complete sense that the company is heading for a good amount of, I think, growth going forward as well. Whatever the past growth that the company has had, now onwards, I think you're going to be seeing the efficiency-led growth due to implementation of AI first in their own setup and then offering the entire AI platform to their customers in different verticals that they talked about, be it agriculture vertical, be it education vertical, be it retail and the commerce vertical and healthcare vertical. The 4 priorities I think they talked about, that is also equally important. So overall, I think the speech conveys that I think they are basically modernizing the business in a one line effect across. Second most important aspect, I think, and this is very important from the perspective of looking at the consumer facing business. Both the consumer facing business, I think categorically a statement has been made that in 3 to 4 years times from now, the size of these businesses, both in terms of revenue as well as in terms of EBITDA, is going to get double, which means you are talking about growing the business at the rate of 25 to 30% rate of growth under the variety of assumptions which they have basically spelled out. So again, to me, this is a very reassuring because retail as well as geo platform put together today are working on annualized EBITDA of around 90,000 to 1 lakh crore. And you are talking about growing the size to 1,80,000 to 2 lakh crores in a span of next 3 and 4 years time. So that means I think this is going to be a solid growth that is coming up. And one last point, I think, on the renewable side of the activity, wherein the comment or the narrative has been made that the business will be positive from the day one, cash flow positive also from the day one. Now, this is a very big statement because you are putting in 75,000 crores in a complex integrated facility. And you are talking about generating cash flows and profitable business from the day one. And again, I think the narrative that I think current O2C business will be surprised, 5 to 7 surpassed in the 5 to 7 year period from now on. So these are some of the key takeaways from the AGM as I see it.
Right. Okay. So let me ask you a quick first question. You talked about the modernization and the efficiency part. Is that somehow also suggesting that growth is slowing down, particularly for traditional businesses?
No, I don't think that the growth is slowing down. Growth will continue at a pace at which I think these businesses have matured and will continue to further grow. In fact, in each and every business area, I think there will be a demand important, I think, which will continue to grow. I think that is given, absolutely. If economy at a nominal rate of growth of around 11.5%, 12% is growing, then all these businesses are expected to grow at around 16 to 17% minimum. So that part is understood. But to remain profitable,
You mean refining petrochemicals and so on?
because to remain profitable is extremely important. They have combined refining and the petrochemical business as an integrated business now. So I think to remain profitable is very important. That's where I like the underlying narrative. Then they want to remain efficiency driven in this business.
Okay. And if you were to look ahead, you talked about the fact that retail and consumer, when you say retail and consumer is the same thing, and digital and telecom could each be about 90 to 100,000 crores of earnings before depreciation, interest and tax. So, and you're also saying that this could double in the next, did you say 5 years or 3 years?
3 years, 3 to 4 years, because Geo platform currently 60,000 crore EBITDA on a yearly basis, run rate on a yearly basis. And the retail is currently somewhere around 33, 34,000 crores, I think, on a yearly run rate basis. That means I think both these businesses put together are around 90,000 to 1 lakh crore kind of a EBITDA making businesses, which are getting doubled in 3 to 4 years' time. So that is showing the growth rate of more than 25% in this business.
Are you expecting IPOs in this? Because that was one thing that was expected in the AGM or from the AGM.
So they believe in giving surprise, Govind. I think they said AGM, I think, was not expected to announce 1:1 bonus. They announced, I think, 1:1 bonus. And I believe that I think retail and the Geo platform would be hyped off at one part of time for sure. I think, but I think they would probably, I think, use the time, I guess, I think, whenever they want to do it.
And your takeaway on the bonus, which is coming after 7 years? Or?
Brilliant, because I think you have already got the shareholder funds of around 7 lakh crores in the books. And you have about 6,700 crore worth of equity. So frankly speaking, you are even talking about 8-9% of your fund, I think, to get capitalized. And at the same time, I think 1,60,000 crore worth of EBITDA is being produced even last year also. Current year, I think even if you assume that 15 to 20% kind of a growth coming in, so I think you're close to 170, 180 plus. I guess I think that is the kind of EBITDA the company is talking about producing. So 6,700 crore capitalization is easily survivable. I guess I think this is also giving the opportunity or thinking, underlying statement, as I read it in between the lines, that they are getting ready for separating out these two units, the Geo platform and the retail. Because when you capitalize your reserve, at such point of time, you are ready for, I think, monetizing your existing businesses. That's where I think you want to give the money back to your existing shareholders. That's what they're doing currently. That is what I take in between the line message.
Any area of concern or disappointment, Deven?
I don't think that, I think, with such a size of company, I think we will remain concerned. If they stop producing growth, yes, I would. But I think here the assurance is that I think growth is, I think, more than that. Frankly, I think the renewable business, they're talking about 5 to 7 years time, overtaking 62,000 crore worth of O2C business. That means you are getting a sign that every year around 50 to 20,000 crore worth of additional profit is going to get added into the books in coming years. So I think there is no disappointment. On the contrary, I'm happy that such a large size company is talking about modernizing the entire manufacturing with Industry 4 standards and giving the opportunity, I think, to the businesses to use AI in a significant manner.
So this is was the 47th AGM, which means only 3 more to go for the 50 years golden jubilee. I mean, when it's 50, I'm sure there'll be a lot of discussion. But as it heads towards 50 and you look back, any thoughts?
Brilliant way of, I think, executions of business. I think that is one single thought, I think, coming in my mind. That each and every vertical which they have grown, be it oil and gas exploration vertical, be it refining vertical, be it petrochemical vertical, or even the consumer facing vertical, the way in which they have been executing the business is mind-boggling. Even in the renewables, I think they're talking about integrated facility, which is even for lithium refinery onwards to battery packs. That is where I think a complete manufacturing facility is being talked about. Even same thing happening for green hydrogen, that in the Westland, I think we are creating the solar plants and using the solar energy to use, I think, with the existing businesses. And also, I think, for the conversion of water into the hydrogen, they are basically going ahead with a good amount of clarity on this particular subject. So frankly speaking, their ability to scale up the business to a larger size is admiring. And I guess I think that spirit is not lost. So I would think that I think we are still heading for, I think, much better times going forward. As even though these companies become so huge, I think they are probably promising that I think it will grow in the range of 15 to 20% year-on-year basis.
Right, Deven, that's a good note to end on. Thank you so much for joining me.
Thank you, Govind. Thank you. All the best.
Corporate growth is moderating. Corporate revenue growth likely moderated to 5 to 7% in April to June, the slowest in 15 quarters, according to a report from Crisil Ratings. Corporate India, or India Inc., is estimated to have logged yet another quarter of moderation in revenue growth at 5 to 7% in the 3 months through June, which is the slowest in 15 quarters, as we said, and the third straight quarter of moderation, according to an analysis of 350 companies by Crisil Ratings. This compares with about 6.7% growth for the same companies in the January to March quarter. So Crisil says that the decline in growth was largely due to a drop in agriculture-linked sectors such as fertilizers, seasonal factors, and the impact of the general elections on sectors linked to construction. In sectors like cement, for example, Crisil said that revenue growth remained moderate on a high base of the year-ago quarter, and large and mid-sized players were under pricing pressure. Similarly, in steel, while domestic demand was healthy, prices moved south, which in turn capped a further improvement in revenue. Crisil also said that consumer discretionary and staple products and services did well, as in they clocked growth. Exports were strong thanks to drug shortages and easing pricing pressure in the United States, which propped up the pharma industry, which exports a lot, or rather half almost, of its products to the United States and overseas. And then there was a modest growth in the IT industry. Investment-linked sectors such as power, capital goods, ports, and shipping also saw strong growth, says Crisil. The power sector, which accounts for nearly 70% of revenue of this vertical, is estimated to have grown 12%, but thanks to prolonged and intense heat waves across the country during the quarter. And finally, when it comes to margins, there was an estimated 50 to 70 basis points improvement in the quarter. Crisil now feels that corporate performance ought to improve in the next quarter thanks to improved demand during the festive season, which is just about kicking off. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.